I'm going to show you exactly what I do to make weekly income every week using a strategy called cash secured put. Now, I'm going to use two tools here in this training. Number one is I use TrendSpider. This is how I use my charts, but you don't have to use TrendSpider. You can use any charting tool. So number two is I'm going to use a broker, Robinhood. And again, you don't have to use Robinhood. You can use any charting tool. But what I do is I sell a cash secured put every single week to make income. I have another video that explains what a cash secured put is. So when I pull this up, I have a scanner that's built in, or actually that I created rather, to scan for stocks that I'm looking for. I'm looking for stocks that are above the 200 period moving average, and also stocks that are above the 20 period moving average, right? So basically what that means is that I'm looking for stocks that are trending to the upside. I'm also looking for stocks that have a positive earnings per share, meaning I want the companies to be profitable. There's a lot of things you can put into the scans, like fundamental analysis on institutional ownership, if people want to buy it, things like that. But I'm just doing it to keep it simple. While it's scanning, I want to tell you some basic things as well. You can use great, solid companies. When you're doing a cash secured put, you really want to use companies that you want to buy, right? Something that's really solid, confident, stocks that you want to own. And you just get paid to buy and sell those shares. So let's go ahead and take a look at my scan here. Let's see what kind of stocks we got. You can see things popped up here. We got all kinds of interesting names. We've got Duolingo. We got Intuit. Wow, Duolingo, man, that thing is really, really rocked to the upside. That's crazy. But you see why if you were selling, the way a cash secured put works is that when the price goes above the strike price, when it stays above, you would make money. So in this case, it's pretty obvious that you would make money, because if you sold one here, you'd make money, right? If you sold one here, you'd make money. You sold one here because it just keeps going up, right? And that's kind of what we're looking for. We're looking for stuff that goes up. Although this one particularly has gone up too much, because you can see the RSI right now is at 85. I'm not going to do that. But so we could even put that in the scan as well. It's greater than 50, but we could put greater, you could add the scan, say greater than 50, but less than 70, so that it's headed in the right direction. DPZ, that's Domino's, that's a really good one. And you can see this is, I actually will go ahead and do Domino's. Now, Domino's, I like this. It's moving up. It's above the 200. It's above the 50. The RSI is moving up. You can see it's a nice stock. And by the way, I would totally love to own Domino's, because it's always been a great stock to own. So now we go into Robinhood once we pick a stock that we like, and we type in DPZ, which is the symbol for Robinhood, or for Domino's. Okay, so we type in Domino's, and we get the option chain. Now, let's just go out. We'll go out over here. This has the expiration dates. So that means that the price will expire on these days. Okay, so this means Friday, it expires in 2 days. May 23rd, 9 days, 16 days, 30 days, and so on. I think for a beginner, 37 days is great. Okay? Anything 30 and above is good. So in order to sell a put, we first identify the current price right here, $484.49. Now, you would sell a put where price is below that. So we have 480, 470, 460, 450, 440, 430, etc. And all that means is that if you choose 470, if the price stays above 470, you will keep 100% of the premium, and you do not have to buy the stock. Now, if price drops below 470, you get to keep 100% of the premium, but then you have to buy the stock at $470 a share. And so what does that mean? You go 470 times 100, that is $47,000. So you need to have $47,000 to do this strategy. And you might be saying, wow, that's a lot of money. I don't have $47,000. Well, yes, I gave you that example, but there are other stocks that you can do this on. One of the ones that I've been doing it on right now has been making me a lot of money, has been TSLL. As a matter of fact, I sold TSLL on Monday for a $12 strike, collecting 88 cents, and it went up so much so fast that I was able to keep most of the money. I was able to sell it for like an 87% profit in just 2 days. Anyways, I'm just going to use Domino's as an example, and you just got to look for different things. But the same rules apply. Let's look at TSLL. The same rules apply if you're doing a low dollar. You still want a good company, right? I was analyzing this. I'm like, okay, we broke out, and it really rocked. But now maybe I don't want it anymore because its RSI is overextended. Okay, but you want a good company, and TSLL is a Tesla ETF, so it's a way to get active action in Tesla without spending as much money, right? Because the market knows, the people that build these ETFs know that not everyone has 47,000. And so the difference is with TSLL at $12, let's go bring that calculator up. At $12 times 100, you only need $1,200. So $1,200 versus 47,000 is a big difference. Now, let's go ahead and just go back to TSL. Sorry for jumping around here, but I want to show you something. So if we sold that that $12, like I had mentioned, it's $1.10. So again, let me explain the way that these work. On this column is the sell prices. So when you sell a put, you click it and you get on the sell side. That's how much you're going to sell. If you buy a put, that's how much you're going to pay. So again, if you sell a put, you collect premium. If you buy a put, you have to pay for it. Now, in this case, if I was going to buy a put, that would mean that I'm expecting price to go down. It's very similar to shorting the stock. So you're going to say, I would buy a put at $1.14, and then you own that put. You pay $1.14 for it, which is $1,114. And then if the stock goes down, the price of the put goes down, and you will make money on that. Okay. But we're not focusing on that. We're only focusing on the bid column, which is sell. So in this case, we would sell this, and you could see you get $1.10. All right. Now, what does it cost? The collateral here is $1,270. $1,270. Because why? Because the stock price is $12.70. Right. So you have to pay $1,270 for that. Now, what's kind of cool though, again, look at this interest. This is $1.10, $110 on 1,200. So that's about a 10% gain. That is a 10% gain on a $1,200 investment in 30 days. Okay, think about that. If you get interest in a bank account, right now you're lucky to get like 3% over a year. This is 10% per month. You do that every single month, and you're going to make really high returns. Okay, now let's take a look at the DPZ example. DPZ, we're going to sell, and we're going to get $869 on 47,000. Now the interest isn't as good, and the reason why is because TSLL is an ETF, and that means you're going to notice that there's a little notification here. Let me show you. It says that it's leveraged. That means that the ETF has a little bit additional risk because the ETF itself is leveraged, meaning they're using options on the ETF. Okay, and so that's just a notification saying that there is additional risk because of options. However, you know, I'm using risk to make money here. I'm using options as well. I think it's a completely reasonable thing to do as long as you're just aware of the risk. All right, so anyways, DPZ, we're going to go, and I'm jumping back and forth, but I'm trying to explain everything really clearly. So step one, we want to sell by collecting premium. The next thing I want to point out to you guys is the delta. The delta. All right, the delta explains the probability of this option expiring above $470. So if we look at the date here, it's 37 days. So the probability of this option is 0.34 on the delta. Now, that means that it has a 0.34 probability. We just subtract that by 100%. So if we just said that this is a 0.3, we would know that it's 70%. 100 minus 0.34 equals, no, not right. 1 minus 0.34 is 66%. So right here, a 0.34 is a 66% probability that you're going to collect 100% of the premium. Now, a trade-off. If you want to drop lower, you're going to get $2 less, but your probability 1 minus 0.25, now you're at a 75%, right? 75% of collecting that premium. So, on the one hand, your premiums go up. On the other hand, your probability goes down. It's always a trade-off, and you as the trader have to determine what you're willing to risk and what your reward is. And I recommend that you look at some mathematical tables. A lot of times it will work itself out because you're going to make more money, but you're going to lose a little more. So at the end, it all works out. The key is that whatever you do, you want to be consistent and you want to always be managing your risk. For me, my sweet spot is in between the 0.35 and the 0.25 because I like to keep my premium up and I like to keep my risk down. I like to kind of stay right in the middle. So for me, that's the sweet spot. I know that if I'm consistently hitting those targets, then I'm going to make money over the long term. Just another thing that I want to share here, the open interest. So open interest is the number of contracts that are currently open and that haven't settled yet. So you can see right here, there's a lot of interest right here at 167, a lot of people here at 237. Why? You're going to see that a lot of times at the 0.25 delta, people are selling a lot of puts in this area, so you're going to see a lot of open interest. And you can see as the price right here, there's a lot. So a lot of people are selling these. And it's just something that you want to look at because you want to make sure that there are other people changing and buying these options. Now, the other thing you want to look at is the spread between the bid and the ask. So right here, you can sell this for 180 or 880, but you can buy it back at 980. So that means you're automatically going to lose $1 on that contract. And so if we take a look here, just put the limit in at 980, you can see that that $1 is actually $100. So right off the bat, in order to close this trade, you're going to have to pay $100, which is a lot to close a trade. So you want to be looking at the bid and the ask. Let's look at TSLL, right? Which is another reason why I like it, is because you can see the bid and the ask here is only 4 cents. So the difference here on that, let's just put it up here. The difference on that is so small. 204 to sell, you get $202. And then if we want to buy it back, we're paying only $3 to buy it back. So it's easier to get in and out of trades. Now on the DPZ example, You don't really have to worry too much, because as the time goes on, this option will decrease in value, and the buying price goes down and the selling price goes down. And that's part of what we call time decay. And you got to remember, when you hold an option, the longer that you hold it, the closer it gets to expiration, the value is always decreasing, which is a good thing, because they're going to pay you, in this example here, $880. Every day that you hold it, that is going to get worth less and less and less. And so when you go to buy it back, you're going to make a bigger profit. You also want to remember, if you let it expire worthless, you'll keep all of it, right? You will keep all of it. So that is how to do an options trade. If you want more information on it, go ahead and check out some of my training in the webinar, and you can consider joining our program. We've had a lot of great responses and results of people that have been using our systems. All right, thanks a lot. I hope that this was a helpful video. Leave comments, questions if you got any feedback for me.